Thank you, Director, and good morning, everybody. I am Richard Scrow, um, the Legislative Director for the Department of Revenue. So this morning I am going to present some of the more significant tax-related legislation that passed this last year. But as always, there is a complete list of tax-related public acts in your handouts as well as on the department's website. But before I jump into any of the new tax law changes, one thing I do like to do is to give people a sense of just how much legislation is introduced each year at the General Assembly. So right now, we're in the 103rd General Assembly, and they were just sworn in this last January, and they will be in office until the 104th General Assembly is sworn in January of 2025. So as you can see, in the first year, the 103rd General Assembly has already introduced nearly 7,000 pieces of legislation. And in recent past, I think there's only been 1 year one General Assembly where we've actually exceeded 10,000 pieces of legislation being introduced. So once the General Assembly returns to Springfield in January of this year, we'll be sure to exceed that 10,000 mark again, and maybe see the most legislation ever introduced in the General Assembly. Now, of those bills, the department has tracked or is tracking over 450 since the start of the spring session. So that's the number of tax-related items that have been introduced in the General Assembly. And again, this number is sure to increase too when the General Assembly returns in January. So this is, like I said, just gives you a bit of an overview of how much legislation that the General Assembly deals with in any given year. And before I jump into what the General Assembly did do this past year, there is one item I want to make note of that the General Assembly did not do this last year. And some of you may be aware of the Invest in Kids tax credit. So for those of you who may not be aware of it, it is a 75% income tax credit for contributions to scholarships for students attending non-public schools. There was a big effort both during the spring session and during veto session to try to get this extended. The advocates for the program were not successful, so it is set to sunset December 31st, 2023, so at the end of this year. So a couple things to keep in mind or to make note of is that contributions can still be made and credits earned through the end of this year. So if you're sitting there waiting for the ball to drop New Year's Eve, you could actually still make contributions and earn credits for this tax year. The other thing to keep in mind is that the tax credit had a 5-year carry-forward provision, so that provision is still in place. So to the extent that a taxpayer has unused credits, they can continue to carry those forward, obviously into future tax years. So now pivoting to what the General Assembly did do this past year, starting with changes to the Income Tax Act. We'll start with Public Act 1039, and that was this year's revenue package. So what the General Assembly has been doing the past several years is any of the tax-related legislation that's kind of agreed to during the course of session, they put it into an omnibus bill and pass it out as one bill. And one of the items within the revenue package deals with investment partnerships. So what this does, it expands the definition of investment partnership. In particular, it provides additional entities are qualifying securities for purposes of satisfying the investment partnership task, and it additionally creates a withholding obligation for non-resident partners. The General Assembly also made some changes to the standard exemption. So for tax year 2023, it kept the standard exemption at the same level it was for tax year 2022, which was $2,425. However, for tax year 2024, it is set to again be increased by the Consumer Price Index. Staying with the revenue package, we have a new tax credit, the Voluntary Emergency Workers Tax Credit. This is a $500 tax credit for voluntary emergency workers, and the term voluntary emergency workers is perhaps somewhat of a misnomer. It seems, I think it connotes a larger impact, but if you read the definition of voluntary emergency worker in the statute, it's really geared towards volunteer firefighters. This tax credit is effective for tax years beginning on or after January 1, 2023 and prior to January 1, 2028, so that will be on this year's tax return. Additionally, it caps the credits awarded at $5 million per year, and the department is responsible for making sure that that cap is not exceeded. So we will be implementing a kind of an application process that taxpayers will have to utilize in order to apply for the credit, and they'll be issued largely on a first-come, first-served basis. The pass-through entity tax also had a tweak to it. The tweak creates a deduction for distributions to retired partners, arguably probably something that should have been included in the initial legislation, just wasn't contemplated. So this is a fix, and this is effective for tax years ending on or after December 31, 2023. Public Act 103-268 created a tax credit for hydrogen fuel replacement. This is a tax credit equal to $1 per kilogram for qualifying hydrogen used. It's effective for tax years ending on or after December 31, 2027 and beginning before January 1, 2029. So obviously you can see we've got a bit of a delayed implementation for this, and at least currently it's only conceived to be around for a couple of years. This is a DCO administered tax credit certificate program, so taxpayers will have to apply to DCEO in order to be granted credits under this program. And this program too has a credit cap of $10 million per year. Public Act 103-8, this deals with business expense deduction for the cannabis industry. So as some of you may be aware, or many of you may be aware, because cannabis is illegal federally, the cannabis industry cannot take business deductions at the federal level. However, this piece of legislation now allows them to do that at the state level. And this is something that the industry has been working toward for a number of years now. And this is effective for tax years beginning on or after January 1, 2023. Moving on to sales and excise tax legislation. First one here is Public Act 102-1125. And you'll note this is from a previous General Assembly, so this was actually passed during the lame duck session, which took place in early of January 2023. And this creates a sustainable aviation fuel purchase credit, or a SAF purchase credit. It's for those of you who might be familiar with the old manufacturer's purchase credit, it's somewhat modeled after that program. So you earn credits when you purchase sustainable aviation fuel, and it's at a rate of $1.50 per whole gallon of SAF purchased. And you can actually use the credit on the purchase, on your tax due on the purchase of any types of fuel. So it's not just use of the credit, it's not just limited to the purchase of SAF fuel, but can be used on the purchase of other types of aviation fuel as well. And this is effective, the original act has it effective June 1, 2023 to January 1, 2033. For those of us who are familiar with tax law, we know that they typically start July 1 and January 1, not June 1, and they end June 30th and December 31st, not January 1st. Despite our efforts to figure out where these dates come from, nobody took credit for it. But we did, as I'll note here in a couple slides, we did pass some trailer language that fixes these dates. These are the sales and excise tax legislation that was included in the revenue package. So one of the things that was included was changes in tax treatment to certain ethanol blends. So gasohol, effective January 1, 2024, will be taxed at 90%. Mid-range ethanol, taxed at 80%. Majority blended ethanol will be exempt. And as I noted, this is effective at the beginning of the year. Farm machinery and equipment exemption was also expanded. This was expanded to now include electric power generation equipment. And this is effective at the beginning of the year as well. The revenue package also made some changes to the Parking Excise Tax Act. The two provisions that I'll make note of in particular that I would say are the most significant. One, booking intermediaries must collect and remit tax for unregistered operators for whom they facilitate parking. This is effective January 1, 2024, and it also requires booking intermediaries to remit tax on that service fee that they collect. So if you use Spot Hero, for example, and you pay $20 for a parking spot and they add a $1.50 fee on it, Spot Hero is now responsible for collecting and remitting tax on that $1.50 up until January 1. It's the operators that were responsible for that. The hotel operator's occupation tax also has a new exemption. This is for organizations chartered by Congress to provide disaster relief, i.e. the American Red Cross, and this exemption was effective July 1 of this year. Continuing on with the revenue package, so as I mentioned, this was a SAF credit trailer, so we fixed the dates to make it effective July 1, 2023 through December 31st, 2032. And we made some other clarifying changes to the enacting legislation as well while we were making those changes. And then I just wanted to touch on a few of the department initiatives that we passed this year. Number one, Public Act 103-396. This synthesizes the pass-through provisions for pass-through tax credits. So you may be aware that there was largely two different ways that a tax credit could be passed through. One was based upon the distributed share of income of the partners and shareholders, and then there were some tax credits that allowed those credits to be passed through based upon an agreement of the partners and shareholders. So now this piece of legislation now for any of the pass-through credits allows either one of those two options to be utilized to pass credits through to partners and shareholders. And this should be the standard going forward. That was one of the things we were trying to achieve too, is have one standard for the pass-through tax credits. Public Act 103-98. This clarifies payment of a liability resulting from a federal change must be made at the time of filing. Otherwise, a payment penalty can be assessed. This isn't really new. The department had relied on a provision in the Illinois Income Tax Act to assess payments or to assess late fees in these situations. However, we thought it was necessary to also include this in the Uniform Penalty and Interest Act, so that's what this piece of legislation does. Public Act 103-9, again, the revenue package had one of our initiatives in there. This provides that payment of an assessed sales or excise tax liability constitutes agreement of that liability. This is a provision that has been around in the income tax realm for a while, so this brings it over to the sales and excise tax. One of the efficiencies that the department will see from this is when we go to close out audits. So currently, even if a taxpayer pays their tax liability, they have to additionally sign the returns, or if they haven't signed them within 30 days, then they're considered final. So this will allow us to finalize those audits as soon as the payment's made. And then Public Act 103-384, this deals with the sales tax exemption for military personnel. So up until this tax law change, military personnel actually had to apply to the department to get an E number. So there was if they were needing to make an exempt purchase, there was somewhat of a delay in them being able to do that because they had to submit an application, had to wait for the department to process, and then issue their E number. So with this law change, all they need to do now is when they go to buy something that qualifies for the exemption, they present their military ID to the retailer, they present a form of payment from the federal government, and then there's an exemption document that they complete as well to document the exempt transaction, and then obviously the retailers will hang on to that to prove that exempt transaction. And lastly, 103-319, this adds non-filed returns to the list of reasons for which an applicant's business registration can be denied. So currently, the department can deny the renewal of a business license if a taxpayer is delinquent on their taxes or if they have unfiled returns, and we can deny a new business registration if an affiliated taxpayer has delinquent tax liabilities, but we don't currently have the authority to deny that, or up until this tax law change, didn't have the authority to deny that if a related taxpayer had non-filed returns.